So Bismillahirrahmanirrahim. Assalamu alaikum everyone. I welcome you all to another session. And as we continue completing our course outline, we are studying more and more of IAS and IFRS day by day. So today we are going to discuss one more very important, very interesting accounting standard. And the name of the accounting standard is IAS 40, Investment Property. Now, this is a very good, not a very lengthy, but a very logical and good accounting standard, and it is examined pretty much in your examinations. It's almost very much part of your final accounts question. There are some MCQs on it, routinely tested. There can be a particular MTQ as well, which is tested in your exam. So you need to make sure you get good grip on this topic, and it will certainly help you move along. All right. So let's start with it. The accounting standard that we are discussing today is IAS 40, Investment Property. I always say that you need to understand the name of the accounting standard if you want to understand the accounting standard itself. So what is IAS 40 and what do you mean by investment property? This is the first question that comes to your mind. So IAS 40 starts by defining what does it mean by an investment property. Now, an investment property is not just a property, because just a property was already catered under IAS 16 property, plant and equipment. So investment property is basically any property. And when we mean property, we mean land and building or both. So when we are talking about land and building as a couple, we call it a property. So investment property is any property. By any property, it can be a house, it can be a long building, it can be a sky rising tower, it can be anything. Investment property is any property that is held for the purpose of capital appreciation or rental purpose or both. Now, here is the thing that you need to understand. Any property kept by any company. Any property kept by any company, but which is for the sole purpose of capital appreciation. I mean that ABC company might have invested in a particular property, and the objective of acquiring this property is not owner occupation. You do not wish to occupy this property. This is not your factory building. This is not your office building. This is not your property which is under your use, but you have acquired it with the sole purpose of capital appreciation. That is, you have acquired to earn some capital gain on it. You wish to earn some capital gain on it. So for example, you have bought it for $10 million and you want to sell it when the prices are high. You want to sell it for example at $12 million. So any property acquired by an entity which is for the sole purpose of not actually living in that property, occupying that property, but you wish to earn from the capital appreciation of that property, from now onwards, it will not be dealt under IAS 16, rather it will be known as an investment property. Any property which is acquired for the purpose of capital appreciation or rental purpose. So if you have acquired any property and the sole objective of acquiring this property is that you want to sublease, you want to lease this property, you want to earn some rental income out of this property. You do not wish to earn economic benefits through occupation, through production, through possessing of that property, but the sole objective is that you want to give that property out on rental and you want to earn rental income. That is also an investment property. So three things you have to consider in mind. Investment property is any property which is held for the purpose of capital appreciation, right? You want to earn from the market values, or it is a property which you have acquired for the purpose of rental income. So for example, you have constructed a shopping mall and the sole objective of constructing that shopping mall is that you want to rent out all the shops in that shopping mall and you want to earn a rental income out of it. So you are basically a real estate investment trust, maybe, or both. The third thing is both. I mean, you can rent out a property and sell it when the prices are high. Both are obviously possible altogether. So investment property is not a owner occupied property, and that is what I'm saying in my second bullet point. I'm saying any owner occupied property Any property which is owner occupied, in short I call it OOP. Any property which is owner occupied property is not, cannot be termed as investment property, because all owner occupied properties are not dealt under IAS 40, but rather they are dealt under IAS 16, property, plants and equipment. So for example, if your examiner says that there is a factory building, now this is an owner occupied property, you produce goods into this factory, this is your running factory, this is IAS 16's property, not investment property. If your examiner says that there is your office building, then this is not investment property, this is IAS 16's property. So you will deal according to IAS 16, not under IAS 40, not as an investment property. So investment property is a property which is held for the purpose of capital appreciation or rental purpose or both. That is the whole idea. And now here also remember, just look at my third bullet point. Also remember, if a company has acquired a property which is held for sale, so when you hear this held for sale, you might wish, okay, we have held it for sale, we will sell it when the prices are high. No, but if you have acquired a property which is held for sale in the ordinary course of business, for example, you are such type of company whose primary objective or ordinary course is to buy and sell properties, is to buy and sell properties. If you are a property agent, if you are a property agency, your job, your ordinary course of business activity is to buy and sell properties, then even those kind of properties are not covered under the purview of IAS 40, rather they are covered under IAS 2 inventories. So any property which is owner occupied, it is not in the scope of IAS 40. Any property which is held for sale, but in the ordinary course of business, I'm meaning that is your sole purpose of the business, then those properties are also not under the scope of IAS 40. They can go into IAS 2. Other than those, any property which is, you know, just acquired as an investment, you want to earn some capital appreciation on it because you feel that prices of property will go high, or you want to earn some rental income out of it. For example, you had some surplus funds and you invested in a property, you wanted to create an alternative investment opportunity, and you are willing to earn some rental income out of it. Those type of properties are known as IAS 40 property, right? So it's an alternative investment, not your primary investment, right? Now there is a third clarification under the scope of IAS 40 as well. Just listen to it. You know, IAS 40 says if a company holds land, now be very particular about this. IAS 40 is very clear about this, what it's saying. We are only talking about land. We are not talking about complete property. We are just talking about land. So IAS 40 says if a company has acquired a land for which there is no decided use, then it will always be classified as an investment property. So for example, if your company has acquired a land for which there is no decided use, I'll tell you a story of mine. I used to audit a particular company when I was in a particular audit firm, Big Four. So I went to audit a particular company, and I saw in their balance sheet that there was a newly acquired land. So there was the company in the industrial area. Just besides their factory building, there was an empty land, and they had just acquired this land during the year. I went to the audit coordinator, the person who was actually, representing the client. I went to him and asked him, sir, that why have you acquired the property, the other property which is just besides your building? Why have you acquired this property? And he said, you see, we are not sure why we have actually acquired this property. We have acquired, our owners, our majority shareholders decided to acquire property because this is middle of the industrial area, and this property was available for sale. So our owners, our directors immediately directed to acquire this property and avail this opportunity. But we haven't decided the use of it. There will be a board meeting in the upcoming quarter, and in that board meeting we are ultimately going to decide what to do with this property. We might sell this land, we might construct a building on this land, we might perform an extension of our factory building. We can do multiple things. It is under a feasibility of the same is being made, but at this point in time we are not sure why or for exactly what purpose this land will be used. And that this immediately came to my mind. See, this is an investment property. You see, any land, any vacant land, I'll make it more precise. Any vacant land for which there is undecided use, it can only be classified as an investment property, because it is fairly obvious. It cannot be classified as your inventory because your ordinary course is not buying and selling property, number one. Number two, it cannot be termed as an IAS 16 property. IAS 16 property. Why? Because this is not a factory building. It is not owner occupied. There is no decided use if we are going to occupy this ourselves or not. So the only category, the only accounting standard that can be applied on such a vacant land for which there is no decided use, it is only IAS 40, because for a vacant land, you can only earn through capital appreciation. You see, on a vacant land, you will not achieve economic benefits of any other sort. From a vacant land, still the time there is undecided use, there is only one potential economic benefit, and that is if the price of that vacant land increases in future. So since you can only earn an economic benefit through a price increase, the only accounting standard that can be made applicable on this vacant land is investment property. So we have understood four things altogether up till now. Investment property is any property which is held for the purpose of capital appreciation, rental purpose, or both. Owner occupied property is not an investment property. Property held for sale in the ordinary course of business is not an investment property. Any vacant land for which there is undecided use, it is always going to be an investment property. And now here comes another area. Which clarifies the scope of IAS 40. IAS 40 says that in case of multi-purpose properties, so for example, there may be a land and a building on which one floor, for example, is rented out and the other floor is occupied by the company itself. For example, you have created an office building or a warehouse or a small factory or a sales office, anything. There is a possibility that a particular building is bifurcated into some rental purpose and also owner occupation. One property can be used for multi-purposes. It is possible. It is practically possible. So if there is a multi-purpose property, then IAS 40 says if both portions are separately identifiable, then apply relevant standard to relevant portion. IAS 40 says that if there is a multi-purpose property and you can determine market value of this floor standalone basis and this floor again standalone basis, if both portions have separate identifiability. What do you mean by separate identifiability? For example, they can be sold separately. You can sell one floor and the other floor remains separate. If there is a building, if there is a multi-purpose property on which both types of floors, the one which is rented and the one which is owner occupied, if both floors are separately identifiable, meaning separately saleable, then you should recognize each portion under its respective accounting standard. So for example, the rental portion will be recognized under IAS 40. And the owner occupied portion, since its separate value can be defined, it will be recognized under IAS 16. Relevant accounting standards are applicable. However, if both portions cannot be separately identified, or otherwise, that standard will be applicable to whole property which depicts portion with significant economic advantages. So the first example was that there is a property in which both portions are separately identifiable. If they are separately identifiable, then apply respective accounting standard on respective portion. But sir, what if both portions, for example, this is a building, it has two portions. One floor is, for example, rented out, and the other portion is owner occupied, and both portions are not separately identifiable. Sir, what happens if both portions are not separately identifiable? Then my friends, IAS 40 says that check which portion offers max economic advantages. Which portion offers max economic advantages? If the company receives maximum economic advantages through rentals, then apply IAS 40 on the whole property. And if the company receives maximum economic benefits through owner occupation, then apply IAS 16 on whole accounting property. The standard which depicts the maximum economic advantages will be applicable on the whole property. For example, I'll give you an example. For example, ABC company constructed a shopping mall, and the shopping mall had 12 floors in it. 11 floors were rented out, and on the 12th floor, ABC company made its own corporate office. Now, this is a multi-purpose property because you have also rented out the property and also it is owner occupied. The 12th floor is owner occupied. Now, there can be two cases. Either the portions will be separately identifiable or they won't be identifiable. Now, let's assume that both portions are not separately identifiable. Then ABC company has to see where they are getting maximum economic advantages. And it's basically common sense that if 11 floors are rented out and only one floor is owner occupied, definitely they are earning maximum economic advantages through rental. Then in that case, the whole property will be subject to IAS 40. You will apply IAS 40 on the whole property. Or in vice versa case, you will apply IAS 16 on the whole property if owner occupied benefits have the most economic advantages. Now, this is applicable when both portions are not separately identifiable. Understood, my friends? So up till now, I believe this is, pretty much logical, and all these points should be well understood by you guys. Done? Now, if you have really understood the scope of IAS 40, then let's go towards the accounting for investment property. IAS 40 is not a very technical accounting standard. From an implementation point of view, it is one of the easiest accounting standards that you can think of. Believe you me, very easy. The recognition criteria is the same as for any asset accounting standard. So as the recognition criteria is when there are future probable economic benefits and the cost can be measured reliably. This is the same as for any asset accounting standard. Recognition criteria is like any asset accounting standard. You can only recognize investment properties in your balance sheet once you have confirmation when there is a probability of future economic benefits, because that is how it becomes an asset. It meets the definition of an asset, and its value can be measured reliably so that you can make a debit and credit with a certain value. But here is the relevant part. Here is the more interesting part. You need to learn the accounting for investment property. All right. Now, according to IAS 40, investment properties can be dealt under either of the two accounting standards. Sorry, two models. I'm sorry. Investment properties can be accounted under either of the two models. either it will be accounted for under cost model, or it will be accounted for under fair value model or market value model. Now it is a choice to the company. It is a choice. It is an accounting policy for the company to follow which whatever model it wants. It can follow cost model to account for its investment properties. And what is that? I'm just going to tell you. It can also account for their investment properties under market value model, fair value model, if they like. It is a choice. It is an accounting policy. But you have to make sure that as per IAS 8, you maintain consistency. It is not allowed for companies to change their models every year. Once you come into cost model, you are under cost model. Once you go into fair value model, you are under fair value model. You have to apply one relevant accounting model with consistency. All right. Sir, can you please explain these types of model in detail? Oh yes, sure. So for example, when we talk about cost model is the same as under IAS 16. It is the even when you study IAS 40 from the horse's mouth, from the IFRS book, it is written in the same manner. The same philosophies of cost model as under IAS 16 are applicable here. Nothing unusual. You under cost model, you will recognize your investment property at depreciated historical cost. That is, you will do cost minus accumulated depreciation to calculate net book value, and at net book value your investment property will be reported, just like how we did under IAS 16. Nothing unusual. But sir, what's new? New is basically fair value model for you. Fair value model is new for you. Now, the proponents or the people who support fair value model, they say fair value model is a much better model to account for investment properties in reality. Because if you think logically, investment properties are properties which you haven't acquired for owner occupation. So you are not actually going to use them in the longer run. That's not your business model. You have just acquired with a view of an investment. Most likely you would have acquired this property with the view that I'll acquire it now because property prices are low, and as and when the property prices reach up to a boom stage, I'll sell those properties and earn some capital appreciation out of it. So if you are very much concerned, if you have really acquired investment properties with the view of earning capital appreciation, then you are pretty much interested in market values. Whatever company, if any company acquires an investment property and it is of the view that it wants to earn some capital appreciation out of it, then it must be watching market values very closely. Now, if the directors are watching market values very, very closely, then we also recommend that you follow the same pattern for your shareholders. Account your investment property under the fair value model so that your investment properties are measured at fair value at each reporting date. So that your investment properties are reported at fair value at each reporting date. That is the whole objective. IAS 40 says that if any entity chooses the fair value model, then investment properties will be measured at fair value, that is market value, at each reporting date. That means on each reporting date, you will need to apply mark to market philosophy. Sir, what do you mean by mark to market? So for example, I'll explain it to you. For example, a company acquired an investment property with a value of $100,000. And let's suppose you follow the fair value model. As soon as 1 year is passed, you will go and check the market value. And let us suppose the market value is 120,000 now. So since you need to record your asset at market value, what would you be doing? You will be bringing your 100,000 asset to the tune of, or to the value of 120,000. Do you understand? You see, if you follow the fair value model, you need to report your investment properties at market value at each reporting date. Now, as soon as the year ends, you will be bringing your 100,000 worth of asset towards market value. So you will be standing up from your mark and going till market, right? You will be standing up from your mark wherever you are and you will be reaching out to market. Now, this process of bringing your assets to market value, this process is known as mark to market. From now on, whenever I want you to revalue your assets or liabilities for that sake, I won't say just revalue or just bring your assets to market value. I will use the terminology mark to market. Mark to market. Mark to market means wherever you are, where at whatever mark you are, just proceed towards the market. Just proceed towards the market. In layman terms, you are required to update the value of your asset towards to market value. All right. So since under fair value model, you have to report your investment properties at fair value, market value. Therefore, at each reporting date, you will need to adopt the philosophy of mark to market. And when you will do mark to market, either the market values will go up or the market values will go down. You see, only two things are possible. You bought an investment property for 100,000, either it will go to 120 or it will go to 80. Either the market value will go up or it will go down. There are only two sides to the market, up or down. So either you will have a fair value gain. When the property prices go up, you get richer. So it is a fair value gain. Or if the property prices go low, you face a loss in terms of market value. So it is a fair value loss. Whatever fair value gain or loss arises, that will go into P&L. That will be recognized in P&L. Not like under IAS 16 it goes into equity, but rather it is recognized in P&L. It is recognized in P&L. Sir, can you please show an example to us? Oh yes, I'll do that. Show an example to us. So basically there is an example question that we are going to discuss, a very easy and a light question that we are going to discuss. So there is ABC company which purchased an investment property for $100,000 on 1st January 2012. So what happens is that on 1st January 2012, the company bought an investment property. And as soon as you buy an investment property, you will be making a debit to investment property debit 120 and cash credit or bank credit 120, right? This would be your entry. Now, since you have bought your investment property, and if you're carrying under fair value model, you need to report this investment property at fair value at each reporting date. So for example, let's just see, you bought it on 1st January 12 for 120K. On the first reporting date, for example, that is 31st December 2012, you will need to update your assets value to fair value. And this process you are going to follow on each reporting date, because under IAS 40's fair value model, your investment properties are always reported at market value, So even after 1 year more, 31st December, for example, 2013, you will still be reporting your asset at market value, and this will continue for each of the years to come. All right. Now, examiner extends this question and says that on 31st December 2012, the first year end, and on 31st December 2013, the second year end, the fair value was 120,000 and 90,000 respectively. So we are going to see both cases, my friends. Both cases. So the fair value goes from, sorry, I've done this mistake. You bought the asset for 100,000. I made this mistake. I'm sorry. You bought this investment property for 100,000. My mistake. So your 100,000 worth of property right? I'll just rub it. So your 100,000 worth of property went to 120k in the first year and 90k in the second year. How are you going to account for this impact? You see, so on each year end, you need to perform mark to market. That is, you need to bring your asset from the previous mark to the market value. And once you mark to market, you will see that the carrying value of the asset was 100,000 in your books. You were carrying the property at 100,000, but the fair value on first reporting date is 120k. So that means a 20k gain. This is a fair value gain. Your property's prices rose by 20,000. And what is going to be the accounting entry for this, my friends? Very easy, very easy. The value of your property rose up. The value of your property rose up. So investment property will be debited by 20,000. Sir, why? Whenever your assets increase, it is debited. So your assets value went up by 20,000. You will make a debit of investment property 20,000. And what is going to be credited? It said that all fair value gains or losses go into P&L. So the corresponding adjustment is going to be not under equity like IAS 16, but it will go in P&L. It will go in P&L. Understood, my friends? And the same philosophy we have to follow each and every year. So for example, if we move on, in the second year, for example, the property prices plunge to 90,000. What will we do then? We still need to perform mark to market. So the carrying value of this property now is, what is the carrying value of our property now at year 2? You have guessed it right. The carrying value is 120,000. Remember, we had already updated our property's value to 120,000. And once you have updated your assets value, you cannot go back. So the real value that you are carrying in your books of accounts for this investment property after this entry was 120,000. Now this carrying value needs to be brought to market value, which is 90,000. So here basically you face a 30,000 fair value loss. And what is going to be the accounting entry for this loss? Very simple. Your assets value has declined, so your investment property will be credited by 30,000 and a corresponding fair value loss will be going into P&L. As simple as that. No rocket science whatsoever. No rocket science. Whatever fair value gains or losses come, they are charged in P&L. Simple, simple. Understood, my friends? So IAS 40 is one of the easiest accounting standards to account for. Yes, you need to spend some time on the concepts, but once you understand the concepts, it is as easy as it can be. Nothing to be done. When prices go up, investment property debit, P&L credit. When prices go down, investment property credit and the corresponding impact goes into P&L as a debit. As simple as that. Now, if you have understood, you still need to understand one thing more, and that is under fair value model, there is no depreciation. You see, under IAS 16, whatever property you had, even if you were carrying it under revaluation model, there still used to be depreciation. Under IAS 40, there is no depreciation, But sir, why? You see, depreciation represents wear and tear of a property. Practically, depreciation represents the outdating or the wear and tear of a property. And when you bring your asset to market values, market values already take the impact of wear and tear. You see what I'm trying to make you understand? IAS 40 says that if you are applying the fair value model, there will be no depreciation accounting. And you say why? Because you see, wear and tear is represented through depreciation, and whatever market participant determines the market value, it also considers wear and tear of a property. Whenever you want, you take a consultant with you, and you take his or her, you take him to the property for valuation. The fair value they calculate is going to account for the wear and tear. They are going to consider the fact that property is already under use, and therefore they will value the property accordingly. Now, since market values already embed the impact of wear and tear, since market values already embed the impact of wear and tear, therefore you do not need to double count depreciation. You do not need to double count depreciation, no depreciation whatsoever, because property will be brought to market value on each reporting date. Understood, my friends? All right. Understood, my friends. So this was a very important concept. Under IAS 40, there is no depreciation. If I ask you, if I take the liberty to ask you that according to your sense, which model is the best model, cost model or the fair value model? Most likely you will say fair value model is a better model, because it represents the true and fair value of a property, updated market value of a property. And since this is an investment property, market values, the representation of market values is the most appropriate method for accounting and reporting to your shareholders. Most likely you will be going to fair value model. Now there will be a question in your mind. Sir, if you know that fair value model is a better model, if I know that fair value model is a better model, why does IAS 40 allow cost model in the first place? There shouldn't be any cost model. Actually, you are right. IAS 40, by its actions, it discourages cost model. You see how? It says even if cost model is applied, fair value must be disclosed. It says that, okay, companies, we have the liberty to apply cost model as well, but even if you do that, you have to disclose fair values. So isn't it fairly obvious that if we have to disclose fair value in any case, it's better, companies would directly jump to fair value model. So it's basically they want to discourage the use of cost model, and that is why they have made it mandatory that even if cost model is used, in any case, you will need to determine the fair value and disclose it. So companies will automatically jump here. They would say, okay, since we are, calculating fair value in any case, why not go to the fair value model itself? So IAS 40 in itself is inclined towards the use of fair value model. It encourages fair value model, that is for sure. All right, my friends. Now having understood the fair value model under IAS 40, it is very important to compare this fair value model, which is referred to by IAS 40, with its predecessor or comparative model of IAS 16's revaluation model. Right, so we have understood that what is fair value model, and investment for IAS 40 prefers that investment model. But in our next slide, let us compare fair value model and revaluation model. Now, revaluation model is one model which is preferred by IAS 16, whereas fair value model is one model which is IAS 40's model. Now remember that why are we comparing these two models? You see, revaluation model is also a market value model, and fair value model is also a market value model. Both models prefer that market value of assets, market value of properties should be reported. But there are certain lines of differences between these two models that you need to understand. For example, when we talk about IAS 16, IAS 16 says that items shall be revalued. Items shall be revalued. They should be, brought onto market values, but with sufficient regularity or when carrying amount materially differs from fair value. Now here is, here is the differentiation point of IAS 40. IAS 16 requires revaluation of properties not on every year basis, but with sufficient regularity, after every 2 years, after every 3 years, or after every 5 years. Whereas fair value model under IAS 40 says that you have to mark to market at each reporting date. So here fair value model brings your investment properties on fair value on each year, on per annum basis, on each reporting date. Whereas IAS 16 can wait for 2 years, 3 years, 5 years, whatever the accounting policy the company adopts. It is flexible in that regard. So there is one difference between these two models. Plus, in IAS 16's revaluation model, any revaluation gain is recognized under revaluation reserve, that is equity. Any revaluation reserve is recognized as an equity gain. So the shareholders benefit when their assets value go up. But when you talk about fair value model of investment property, since investment properties are such type of properties that represent the sole purpose of investing, right? Investment properties are not owner occupied properties. These are not those properties which you invest to gain in the long term, but rather investment properties are an investment tool. You see, when you study financial management, for example, if you're studying CFA, there is one subject known as alternative investments. Under alternative investments, the primary focus is to invest in alternative instruments. Like, you don't invest in derivatives, you don't invest in financial instruments, rather you invest in different form of assets which are other than financial instruments. So investment property is an alternative investment, and since investing in an investment property is an alternative investment, it is with the sole purpose of earning a gain. So if a company has surplus cash and it invests in a property to earn capital appreciation, it represents the purpose of earning something out of it. And since it represents the purpose of earning out of it, it is the business model it represents. And since it is a business model, any gains or losses are business gains and losses. And that is why IAS 40 says that all fair value gains and losses go under P&L. All fair value gains or losses go in profit or loss accounts. It is a business loss or a business gain. It is the business investment, that it is the business cash that has been invested alternatively. So whatever gains or losses go into P&L. And the last but not the least difference between IAS 16's revaluation model and IAS 40's fair value model is that under IAS 16, depreciation is still recognized but on revised values. Under IAS 40, we just talked about it, that under IAS 40, there is no concept of depreciation, since impact of usage and wear and tear is already embedded in fair value. There is no concept of depreciation. There is no concept of depreciation in fair value model. You see, so often examiner asks you that what is the difference between IAS 16's revaluation model and IAS 40's fair value model. Now the similarity is that both focus on market values, but the differentiation is that one does not require mark to market on each year, but IAS 40 requires that. There is no depreciation under fair value model, but there is under IAS 16's model. So you need to clearly distinguish between these two models. Now, there is a common question by many students and academicians and practitioners that why actually fair value gains in IAS 40 are not recognized in reserve? Why are they not recognized in equity? And I'd like to further explain this point, because this needs to be very clear in your mind, that why IAS 40 does not prefer fair value gains to be recognized under equity. Why no prudence concept is being made applicable here. And I'll tell you this. So for example, just try to understand, this is pretty much technical. In case of investment property, fair value gains and losses are an important aspect of investment appraisal. I'll tell you what I'm trying to say here. You see, your shareholder gave you some funds, and most likely if there was a surplus, you invested your shareholders' money, the business's money, which was contributed by the shareholder, in an investment property. Now, when you go to the board, when you go to the shareholders, they would want to appraise your decision that whether you have rightfully invested surplus funds alternatively in investment properties. You could have invested that money in bank account, you could have invested that money in financial instruments, but rather the company chose to invest that surplus money in investment property. Is it a good investment, yes or no? Is it a good investment, yes or no? And how will your shareholders appraise if it's a good investment, yes or no? They will, they will appraise the returns out of this investment property. Now, what returns does investment property give you? They give you, returns in the form of rental income, right? And the other return they give you, the investment property gives you, is capital appreciation, right? There are two sorts of gains which you can earn and provide to your shareholders when you invest in an investment property. Now, isn't it pretty obvious that there should be one tool for appraising this investment? You see, your rental income goes into your P&L. Rental income is an other income and it goes into your P&L. Now, if rental income goes into your P&L, your fair value gains or losses should also go in P&L, so that this investment appraisal is practically possible. Just imagine your rental incomes been recorded in P&L, but your capital appreciations or capital losses had been recorded in equity. So how will your shareholders actually appraise if this is a right investment or wrong investment? How will they connect the dots? They won't be able to do that. So it's very important that your shareholders are able to connect the dots and really appraise that if this investment was worthwhile, yes or no. And they can only do that if we show all types of investment property returns under one statement. And my fellows, you need to understand that this one statement is profit or loss. Obviously, you cannot take rental incomes into equity. Rental incomes are not an equity return. So if rental incomes go into P&L, your fair value gains or losses should also go in P&L. So that investment appraisal is really possible. One reason. The other reason, and my friends, I'm very sorry to say, but this is a more technical reason to understand. This is a more technical reason to understand. You see, and this is given by IAS 40. It explains its basis for conclusion. Investment property generates independent cash flows, unlike property, plant, and equipment. Now, this is something technical for you to understand, my friends. And you need to understand at this level only, because you will not get this knowledge anywhere else. You see, when you talk about your property, plant, and equipment property, a factory building, does not provide you direct cash flows. If you have a factory building, you do not earn economic benefits directly from the factory building. Rather, that factory building is used to produce some products. It is used to produce some products, and those products ultimately earn you a revenue. Do you understand? And that revenue is already in P&L. Just try to understand what I'm trying to say. I'll repeat it once again, because it needs to be very much clear in your minds when we are talking about property, plant, and equipment, IAS 16's property. Please try to understand. Because property, plant, and equipment, IAS 16's property, factory building, does not provide you direct cash flows. It provides you the facility to produce goods, and those goods earn you revenue, and that revenue is already represented in your P&L. So the benefit of factory building is already represented in P&L. Understood? It does not provide you any direct cash flows. Whereas investment property, on the other hand, provides you direct cash flows. A factory building does not earn you a single dollar, a single cent on its own. It is the goods that earn you some money, and those are already represented in P&L. However, IAS 40 provides you direct cash flows, direct cash flow. They have identifiable cash flows. And if it's an identifiable cash flow, and these direct cash flows comes through an investment tool, this should be represented independently in your P&L. If you do not recognize your fair value gains or losses directly in your P&L, your investment property is not truly reflected. You see the major return an investment property earns you is the capital appreciation. Rental incomes are a minute level of income as compared to the whole investment property's value. So for example, it might take you to construct a huge shopping mall $100 million. I'm just assuming this number. Don't judge me on this. For example, it might take $100 million for you to construct a building. And even if you earn rental income, that may be 1% or even less of the total investment that you have done in your investment property. So the real benefit that an investor earns through investing in an investment property, it is the capital appreciation. And it is directly identifiable. If you take these capital appreciation, capital gains and capital losses and throw it into equity, throw it into reserve, your investment property is not reflected in your business model. Your investment property is not reflected in your P&L. Now, in order to reflect these direct cash flows, you need to make sure that your fair value gains and losses go in P&L, so that these directly, earning cash flows are represented in your business model, in your profit or loss statement. That is the reason why IAS says that all fair value gains and losses should go into P&L. Now, this has been examined long ago when F7 and FR used to be a descriptive paper. Your examiner used to ask these type of questions, that what is the real difference between revaluation model and fair value model. And believe you me, when you go into the next paper, into your SBR paper, this knowledge is going to be practically examined many a times, because your examiner, IASB, they are very much worried about the fact that students know what to account for, but why do they account for like the way they are doing? They don't know the concepts. So I want you to know the concepts, and that is why we are discussing all of this detail. All right, my friends. So sometimes my student often feel that, sir, you are just dragging a topic, you are just going into very much minute details. And that is my style of teaching. I want to deliver you the core concepts of how an accounting standard is basically developed. Just rote learning of the rules, I don't feel this will help you in your future. So I really want you to develop yourself as an accountant who has basics embedded in them, so that when you grow up after 5 years, 10 years, or maybe 20 years, you are able, one fine day you may say that, sir, after your teachings, we were able to contribute in accounting standards making. I have that level of aspiration for you guys, and that is why I am delivering you these concepts. All right, my friends. Good. So till here, we have understood that the accounting for IAS 40's investment property model is not a difficult one. It is a very easy accounting to do. Just mark to market and all fair value gains and losses go into P&L, and you even don't have to worry about the depreciation. But the underlying concepts you have understood till now. Now let's move on to a more challenging area under IAS 40. This is a bit of challenging. Not very much challenging, but this is something which you need to understand by heart. This may be the only technical area under IAS 40 that you need to understand. The area that we are discussing right now under IAS 40, my friends, is basically changes in use. Sir, what do we mean by changes in use? You see, there is quite a good possibility that with time, entity changes the methodology to use a property. It is quite possible that when an entity grows, in future, the entity might change the philosophy of utilizing a particular property. It may be a scenario that if previously your property was owner occupied, you had an office building there, And subsequently, when you feel that, okay, work from home styles is working out, or for example, you feel that we don't want an office here, we want an office somewhere else in a more, more in the city you want. A company might say, okay, this was previously our owner occupied property. We are renting out this property, so it becomes an investment property. It is possible. It is also vice versa. There can also be a case of vice versa. For example, there was an investment property that you had previously rented out, but now your business is growing and you want that property to be your owner occupied property now. You can change your investment property to an owner occupied property likewise. So a change in use is possible. A change in use is possible. You can make your owner occupied property an investment property, or your investment property an owner occupied property. Understood? Now, IAS 40 says that if there is a change in use, then there should also be a change in accounting standard. If there is a change in use, then there should be a change in accounting standard. If, for example, you are going from an owner occupied property to an investment property, then you should debit your investment property and credit your owner occupied property. The classification should change. The accounting standards should change. And likewise, if your investment property tomorrow becomes an owner occupied property, so you should change the classification and the applicability of the accounting standard. You should credit your investment property because it is not, it is no more an investment property, and rather you should debit owner occupied property, so that you change the accounting standard. All right. This is what has to happen. Now there is one problem. You see, when you talk about IAS 16, it has two models: cost model, revaluation model. When you talk about IAS 40, it has two models: cost model and fair value model. Understood? When you change the use, you have to change the accounting standard, but both accounting standards have two models in them. So just imagine, it can be a cost model to cost model shift. Either way, it can be a revaluation model to fair value model shift. It can be a revaluation model to it can be a fair value model to revaluation model shift. It can be anything. So we need to understand the accounting, we need to understand the pattern of accounting for changes in use in quite various ways. I'll teach you this topic with reference to 3 cases. And I'm very sure if you study these 3 cases, all the possible cases in the whole wide world, you'll be able to deal with them. These 3 cases are important, but you need to remember the tool. Remember, you need to remember the tool. The philosophy is, if there is a change in use, there must be a change in accounting standard. And how is that going to happen? We'll study through these 3 cases. The first case that we are discussing, my friends, is basically case number 1, cost model to cost model transfer. Cost model to cost model transfer. So I'll give you an example. Just look at my example, please. So for example, ABC company, there is an XYZ company who bought an owner occupied property, a building, at a value of 100,000 with a life of 10 years. On year 0, ABC company bought an owner occupied property. All right. So building debit and cash credit. Done. After 2 years, now remember, 2 years have passed. 2 years have passed. Now, since 2 years have passed, there must have been depreciation. Now, 2 years have passed, and after 2 years, a change in use occurs, that you make your owner occupied property and investment property. You make your owner occupied property and an investment property. So after 2 years, the accounting entry is already known. The standard in which you are going, should be debited. It is now going to be an investment property, so you should debit investment property. And the standard from which you are coming out, should be credited. So P, P and E should be credited. A change in classification needs to occur, a change in accounting standard needs to occur. But the point I'm trying to make here is, it doesn't matter about the accounting entry. The accounting entry is already known to you. The question is, on what value this accounting entry, on what measurement basis this accounting entry is going to pass by. How you are going to measure this accounting entry. So the process is pretty simple. The date the change in use occurs, you calculate its carrying value. Sir, what is the carrying value? So you had an asset which had an original value of 100,000. Life was 10 years. So definitely depreciation was 10,000 per annum. You will subtract 2 years of accumulated depreciation, since this was occurring 2 years after. So you will subtract 2 years of depreciation from here and get a carrying value of $80,000. And whatever the carrying value is on the date of change in use, you will just make a transfer entry. On this value. So 80,000 investment property debit, property, plant and equipment investment property credit. Sorry, property, plant and equipment 80,000 credit. So here you now know that whenever there is a shift from cost model to cost model, the game is not difficult. My friends, the game is not difficult. You don't need to do anything. You just calculate the carrying value and make the transfer entry. When there is a shift from cost model to cost model, no particular difference. Just calculate the carrying value, the real value at the date of transfer, and just make the shift. So the summary is, calculate carrying value at the date of change in use and make transfer entry. As simple as that. Nothing technical, my friends. In cost model to cost model, nothing is technical. It is, I mean, this type of mechanism you should have thought yourself. IAS 40 doesn't even need to define it. Just calculate the value which is relevant at the date of transfer, carrying value, and just make the shift. No difficulty. But you know when the difficulty comes in? The difficulty comes in case 2 and 3. And it's not going to be pretty difficult. Don't worry. All right. So whatever I've written here is basically, in local Urdu language. I'll just translate it. Don't worry. So it is very important to understand what I'm just going to say right now. It is very important to understand. Sir, what if the case is that you are shifting from IAS 16 to IAS 40, but the change is from revaluation model to fair value model? So these two models are the models which represent market value. These models are basically, these represent market value to market value shifts. Now there is a slight difference. in the accounting pattern of these type of cases, and I'll explain to you very simply. And again, I'm just saying, just ignore whatever is written here. All right. Understand. I'll make it very easy for you. So let's take an example for you to understand. We bought a building which is obviously owner occupied. We are under IAS 16. So we bought a building which was worth $100,000 with a life of 10 years. All right. Now, after 1 year, a change in use occurred. Such that your owner occupied property became your investment property. Your owner occupied property became your investment property. All good? You bought a building for $100,000 with a life of 10 years, and after 1 year, your owner occupied property became your investment property. There is a change in use. If there is a change in use, my friends, then there should always be, my friends, there should always be a change in accounting standard. So we are very much clear that we should prepare an accounting entry here that investment property should be debited and property, plant and equipment IAS 16 should be credited. This is the way to go about it for sure. But how is that going to happen under such circumstances? This is a bit different. You see, the first fact that you have to, the first act that you have to perform is to calculate carrying value at the date of change in use. And sir, what should be the carrying value at the date of change in use? You had a building which was worth $100,000. Life was 10 years and 1 year has passed. So definitely the accumulated depreciation would be $10,000. You get a carrying value of $90,000. You got the carrying value. Done. But you know what the rule says? What the rule of IAS 40 actually says? IAS 40 says, and I'm going to write it under a different, pen color. If on any side of the shift, there is market model, then at the date of change in use, market value is triggered. You see, my friends, if you are making a change in use, it is not a normal transaction. If you are making a change in use, it is an unusual transaction. And as a principle, my friends, even when you go in SBR, this is going to be tested in your exam pretty much descriptively. I'm telling you it from this day that, my friends, whenever in accounting there is an unusual transaction, a big transaction, a transition of something, fair valuation is triggered. So IAS 40 says, if at any side there is a market value model. If you look at this example, revaluation model is a market value model. Even fair value model is a market value model. IAS 40 goes to say, if even at only on one side there is a market value reference, either the first model was a market value model or the transferred model was a market value model, even if there is a market value reference on one side of the transaction, there is, here there are two fair value references. From you're coming from a fair value model, you are going to a fair value model. But even if there is a fair value reference on even one side of the transaction, fair valuation is triggered. Market value is triggered. So what you need to do is that you need to calculate fair value of your property. In this example, the fair value of your property was 110,000. You need to compare your carrying value with your fair value, and then you will see that there is a 20,000 gain. Now there is one more thing that IAS 40 says. Fair valuation at this date, which date? The date of change in use, is accounted for under the old model. Sir, what are you saying? We don't understand. IAS 40 says that whenever you are making such a change in use, and then you have to calculate fair value, and when you get a fair value gain or a fair value loss, it always has to be dealt according to the old standard, the standard from which you are coming. So here we are going from revaluation model to fair value model. So any gain or loss that arises at the date of change in use has to be dealt under the old model, has to be dealt under the old model, and then a transfer entry will be made. So the old model in our case, in this example, is revaluation model. So this is to be termed as a revaluation gain. And what entry will you be preparing for this revaluation gain? You will be making a PP&E debit of 20,000 and you will be crediting OCI or revaluation reserve by 20,000. So your 90,000 value asset comes to 110,000. Always perform fair valuation under the old model and then make a transfer entry. I'll write it down here as well. Always account for the fair value change under the old model and then make the transfer entry. Where will you find such a teacher which writes everything down? I'm just spoon feeding it to you. That's my style. That's my style. I can't help it. So, all right. So you see that you have to account it for under the old model, and that you have done. And once you have done this, just make the transfer entry. Here is the transfer entry. Now your investment property's new value would be 110,000 and your property, plant and equipment would be credited by 120,000. This is your transfer entry. Now remember my friends, don't forget this. Once you have done this, remember that once you have done this, from now onwards, IAS 40 is applicable. Once the transfer entry has been made and you enter into a new accounting standard, IAS 40 is applicable. So in year 2, you are just going to mark to market under IAS 40. You are just going to mark to market under IAS 40. How you are going to do that? The way IAS 40 works. You are going to take the carrying value. By the way, there is no depreciation. So your previous value of 110,000 remains your book value. You will compare your fair value at the reporting date, which is for the second year, it is 120,000. You get a gain of 10,000. This is your fair value gain, and you recognize it under P&L. It is recognized under P&L. This is how you are going to solve it. Make sense? So what do we conclude from here? We conclude from here that whenever there is a case of change in use, an accounting standard change is always applicable. And whenever there is a change and on the either side there is a market value reference, then you revalue your asset while remaining under the old standard and then make a transfer entry. And once you make the transfer entry, normal situation prevails as per the relevant accounting standard. That is the process that you have to follow. All good? Let's see another case. It is getting interesting as we move on. So let's see a vice versa case. Sir, what if we are shifting from fair value model to revaluation model? My friends, same philosophy has to be followed. Same philosophy. Just look at the example. So let us say that on year 0, a company had an investment property with a value of 100,000. Investment property with a value of 100,000. If you have an investment property, it would have been carried under IAS 40. And we are talking about fair value model, right? So after 1 year, what happens? There a change in use occurs and your investment property becomes an owner occupied property. Your investment property becomes an owner occupied property. So if there is a change in use, there must be a change in accounting standard. There must be a change in accounting standard. So definitely what you have to do is you need to debit your property, plant and equipment, the standard that you're going in, and you need to credit your investment property, that is standard that you're coming from, right? And how is this going to work? IAS 40 says that you remain in your previous model and do mark to market valuation. How do you do that? So you had a building with a carrying value of 100,000. Remember, under IAS 40, you don't depreciate your assets. Your carrying value was 100,000. Your fair value at the date of change in use is 120,000. You get a fair value gain of 20,000, and that has to be recognized in P&L. You remain in your previous accounting standard, just mark to market your asset, mark to market your investment property. Once that has been done, you make the transfer entry. Just make the transfer entry. How do you make the transfer entry, my friends? You make PP&E debit by 120,000. You make your investment property credit by 120,000, and your entry is finished. This is the transfer entry that you have to prepare. Now it is no more an investment property, my friends. It is a property, plant and equipment property now. And from now onwards, IAS 16 is applicable. From now onwards, IAS 16 is applicable. And since IAS 16 is applicable, you will have to depreciate this asset. So you will need to calculate depreciation. You remember the basic formula for depreciation is that you take the value in numerator and divide it by life. So the assets value is 120,000. Remember, we debited PP&E with 120,000. Examiner says that your remaining useful life at this date, RUL, by RUL I mean remaining useful life. Your remaining useful life is 12 years. So you divide it by 12 years, and that you're going to have a depreciation of 10,000. If someone asks me what is the carrying value at year 2 of property, plant and equipment, I would say 120,000 minus 10,000, and the carrying value is 110. Just like IAS 16 works, nothing unusual, my friends. So you see this. Now whole of this slide is, so much jumbled up. I would request you to just write this down, make your own notes, my friends. The best part, I always say, in order to become a very good teacher, you need to be a very good student. If you are not a good student, you cannot become a good teacher. And also, if you want to become a good teacher, teach yourself. Just write it down on a piece of paper and teach yourself the sayings of IAS 40, and you will get good grip under, on this accounting standard. Just make your own notes. If you can teach yourself, you can teach anyone in this world. The hardest person to teach is yourself. The hardest person to teach is yourself. How I became a teacher? Long ago, just few months back, just few years back, maybe more than a decade back, when I was studying, I used to teach myself in order to clarify my own concepts. I used to read books, I used to read IFRS books, but also I used to teach my own self. And the more I used to teach myself, the more confident I became. And just by when you teach yourself, ideas come into your mind, how easily you can explain yourself, and that helps you in your exam. Because in your exam, nobody, ACCA is not a qualification, accountancy is not a profession where people ask you about rote knowledge. Do you know this? Do you know that? Do you know this? Do you know that? It is not about rules. It is all about concepts. I don't agree with the fact that you should, just have rote learning of everything and don't have any concepts. That is not the right way to go about it. Make yourself strong. Make yourself strong. This is the right strategy. All right. So gladly we have completed IAS 40. There is just one remaining area that I need to touch upon. It's important. For me, it's fairly important. So I need to touch this. The area that I want to refer is IAS 40 investment property in group structure. So my friends, I know that you're going to say that, sir, wait. We have not studied consolidation yet. We have not studied group accounts yet. So isn't it a bit too early to study about group structures? Actually, you just need to know the basics of group structure. I'm not in detail going into consolidation, but just referring it, by the way. Just try to listen to me what I'm trying to say. So you see what happens in a group structure, that one company, say parent company, acquires the control of another company, which is subsidiary company. And each company prepare their individual financial statements. Each company is responsible to their shareholders, and that is why each company prepare their individual standalone financial statements. They do that. But in addition to the normal responsibility, parent company, being parents, have to make some family accounts as well. Some family accounts as well. The whole group accounts they also have to prepare. So parent company, also responsible for group accounts, right? So you understand the basics of consolidation till here. Now just try to understand what I'm willing to say. Take an example. Parent company rented its property to S company. By the way, is this possible? You see, parent company had a premises available. It acquired S company and rented its premises to S company. Is it anything unusual? No. A very normal transaction. This can happen. Now, if parent company has rented a property to its subsidiary company, in the individual financial statements, when we talk about the individual financial statement, in the individual financial statement, if one company rents out its property to another company, this is supposed to be treated as an investment property, right? In individual financial statements, parent company has leased a property to any other company. It is, it's a subsidiary company. In individual financial statements, it is simple and investment property, nothing technical. But my fellows, when we talk about group accounts, now when you prepare group accounts, my friends, then all assets and liabilities of the group are treated as ownership of the group, I would say. You see, as far as the individual financial statements are concerned, parent company is a separate company and S company is a very separate company. So in individual financial statements, since parent company is an independent company in itself, if parent company has given leased property to any other entity, a subsidiary company, it is to be treated like an investment property. No worries. But if you are making group accounts, then you don't treat parent company as a separate company and S company as a separate company. Both companies are a single economic entity. So from a group point of view, these two companies are not two separate companies. When you're preparing group financial statements, you don't say that parent company is a separate company and S company is a separate company. From group point of view, both of them companies are one single family. They are one group. They are one single economic entity. So from a group point of view, this property, which was earlier rented out to an S company, this property is still part of the group. So I would write it down. So from group point of view, property is under occupation of the group. Make sense? From an individual perspective, one company had rented out its premises to another company. From individual perspective, this was an investment property. But when you're preparing your group accounts, you don't say there is one parent company and there is one S company. There is only one group. And the property is being utilized under the group. And if the property is being utilized under the group, it is under owner occupation. So therefore, this property will be treated as property, plant and equipment as per IAS 16 in group accounts. right? So this is the difference between treating a single property in two different financial statements. In individual financial statements, it will be treated as an investment property, but when you're talking about group accounts, under group accounts, this will not be treated as an investment property because it is being utilized, it is under owner occupation of the group. From group point of view, this is an owner occupied property. IAS 16 will be applicable. All right. So although this area won't be examined, pretty much technically in your exam, but you need to have this knowledge. This will be healthy when you're solving some MCQs. You are even when you reach an SBR, this is descriptively asked. So you need to have this level of understanding. I believe that I've done my part in IAS 40 and this was helpful. So I'm always available for queries. If you have any query in this regard, just let me know. But here we have completed our IAS 40, a very interesting accounting standard, very examinable accounting standard. I hope you liked it. I took my time to explain this accounting standard in detail to you. This was my agenda since day one, because some accounting standards you need to spend time on. If you do that, ultimately in the long run, you will benefit. In the long run, you will be spending less time on practical questions if you spend more time on concepts. This is my methodology of teaching. So thank you very much, everyone. Take care. I will meet you next time. Thank you. Allah Hafiz.